Imagine this. You open your investment app. Your portfolio is down 27%. Every news headline says the word recession. Your coworker just told you he moved everything to cash. Your uncle says this is just like 2008. And your brain is screaming, should I sell before it gets worse? And if you're being honest, you're not thinking about getting rich. You're thinking about surviving. If that's you right now, this video is going to feel uncomfortably accurate. Because here's the thing. Recessions don't destroy wealth. Panic does. Introduction. My name is Peter, and I spend way too much time thinking about investor psychology and long-term wealth building. If you're someone who feels anxious every time the market drops and secretly wonders whether you should just move everything to cash, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, most people think investing during a recession is about predicting the bottom. It's not. It's about positioning yourself so that when the recovery happens, and it always does, you're one of the people who benefits. Today we're going to break this down step by step. The math of investing during downturns, the psychology that causes people to sabotage themselves, the exact strategy I would use, and what most people don't realize about recessions. Because this is where it gets really interesting. Part 1. The lie we tell ourselves during recessions. Here's what most people believe. I'll sell now, and I'll buy back in when things look better. Sounds smart, sounds rational. But history tells a very different story. According to data from J.P. Morgan Asset Management, if you invested $10,000 in the S&P 500 over the last 20 years and stayed fully invested, you'd have over $60,000. But if you miss just the 10 best days in the market, your return gets cut nearly in half. And here's the part no one likes to admit. Those 10 best days usually happen during periods of extreme fear, often right after massive drops, meaning the people who panic sell, they almost guarantee they miss the rebound. This isn't about intelligence. It's about emotion. Part 2, what a recession actually is and isn't. Now you might be thinking, okay, Peter, but this recession feels different. People said that in 2000, dot-com crash, 2008, financial crisis, 2020, pandemic crash. And yet, markets recovered every single time. According to data from the National Bureau of Economic Research, the average U.S. recession since World War II has lasted about 10 months. The average bull market? Over 5 years. Let me repeat that. Recessions are temporary. Growth is long-term. But psychologically, pain feels permanent. That's called loss aversion. Behavioral economists like Daniel Kahneman found that losses hurt about twice as much as equivalent gains feel good. So when your portfolio drops 30%, your brain reacts like you're being chased by a bear. It's not logical. It's survival wiring. Part 3, the math of buying during a recession. Let's remove emotion for a second. Let's say you invest $1,000 per month. Scenario A. You stop investing during a 12-month recession. Scenario B. You keep investing consistently. Assume the market drops 30%, then recovers 40% over the next 2 years. If you stopped investing, you avoided short-term pain. But if you kept investing, you bought assets at a 30% discount. Let's use real numbers. Stock A is $100. Recession hits. It drops to $70. You invest $1,000. At $100, you'd get 10 shares. At $70, you get 14.2 shares. When it recovers to $100 again, those 14.2 shares are now worth $1,420. That's a 42% gain. And you didn't do anything fancy. You just didn't panic. This is where it gets really interesting. According to historical market data compiled by Fidelity Investments, markets have delivered positive returns over rolling 15-year periods nearly 100% of the time. Recessions don't erase long-term wealth. They discount it. Part 4. Why most people fail to invest during recessions. Here's what most people don't realize. Recessions don't just hit portfolios. They hit confidence. Job security feels uncertain. News feels catastrophic. Everyone around you is negative, so you pull back. Not because it's mathematically smart, but because it feels safe. This is called herd behavior. We evolved to survive in tribes. If everyone runs, you run. But in investing, the crowd is usually wrong at extremes. Warren Buffett, and yes, I know everyone quotes him, famously said to be fearful when others are greedy and greedy when others are fearful. But here's the problem. It's easy to say that in a bull market. It's extremely hard to do when your net worth is shrinking. Part 5. The strategy I would use. If I were investing during a global recession today, here's exactly what I would do. 1. Strengthen my emergency fund first. Before investing aggressively, I'd make sure I had 12 months of expenses in cash. Why? Because if you're forced to sell investments to pay rent, you lose the advantage. Security creates confidence. Confidence allows discipline. 2. Dollar cost average relentlessly. Instead of trying to time the bottom, I'd invest a fixed amount every single month. No guessing, no predicting, just automation. Because here's the truth. You will not time the bottom consistently. Professional hedge funds struggle to do that. Why would we expect ourselves to? 3. Focus on broad market index funds. During recessions, weak companies fail. Strong companies survive. Broad index funds naturally rebalance toward winners over time. That's the hidden advantage. Creative destruction works in your favor. 4. Increase contributions if income is stable. Now, you might be thinking, Peter, increase contributions? Are you crazy? Look, if your job is stable and your emergency fund is solid, recession periods are historically the best time to be aggressive. After the 2008 crash, the market eventually rose over 400% from its lows in the following decade. The biggest returns often come after the worst headlines. Part 6. The psychological game. Let's talk about the real battle. It's not spreadsheets, it's self-control. During recessions, news becomes addictive. Volatility increases. Social media amplifies fear. Your brain confuses volatility with risk. But volatility is price movement. Risk is permanent loss. Those are not the same thing. If you own diversified assets and don't sell, volatility is temporary. Permanent loss usually comes from panic decisions. Part 7. A story. In 2008, imagine two investors. Investor A sells after a 35% drop, moves to cash, waits for clarity. Investor B keeps investing monthly. By 2013, markets had recovered dramatically. Investor B not only recovered losses, but had significantly more shares accumulated at low prices. Investor A, still waiting for certainty. Certainty is expensive. It usually arrives after prices have already gone up. Part 8. What most people don't realize about recessions. Here's what most people don't realize. Recessions transfer wealth from the impatient to the disciplined. Asset prices drop. Real estate weakens. Stocks fall. But ownership doesn't disappear. It changes hands. If you have cash, stability, and courage, you're positioned to benefit. If you panic, you fund someone else's future returns. That's harsh, but it's true. Part 9. Clear action steps you can apply today. Let's make this practical. Here's your recession investing checklist. Build or confirm 6 to 12 months emergency fund. Eliminate high-interest debt above 8–10%. Automate monthly investments. Avoid checking portfolio daily. Increase contributions if financially stable. Rebalance once per year, not emotionally. Simple. Not easy, but simple. Part 10. The long-term perspective. Zoom out. If you're 25 and investing for retirement at 65, you have 40 years. In 40 years, you will experience multiple recessions, market crashes, political turmoil, global crises. And yet, historically, markets trend upward over decades. Why? Because productivity increases, innovation continues, companies adapt. Betting against long-term human progress has historically been a losing strategy. Closing motivation. Look, a recession is scary. It tests your conviction. It makes you question your plan. But this is the moment that separates average investors from wealthy ones. Not intelligence, not secret stock picks. Discipline. Years from now, you won't remember the headlines. You'll remember whether you stayed consistent. So instead of asking, how do I avoid this recession? Ask, how do I position myself to benefit from the recovery? Because the recovery always comes. The only question is, will you still be invested when it does? If this video helped you think differently about investing during a global recession, hit subscribe, give it a thumbs up, and share it with someone who needs to hear this before they panic sell. I'll see you in the next one.